Hello traders, welcome to FreeFX. Today is the 3rd of May 2016. My name is Francesco Sani. The topic of today's video is one that has been requested by a forum user on babypips.com. That's Eddie, and he suggested this topic because it is a very common one to be featured on the questions from newbie traders. So the topic for today is popular indicators, and I've chosen this topic because indeed it comes up again and again. A lot of new traders find that using indicators is a way to steer themselves into a clear direction for choosing trades, not based on market sentiment or fundamentals, but based on signals that indicators reinforce. So I've taken the time today to make this again free video for people who are looking for the first time into the indicators arena and how to add them, etc. I'm going to use my trading station here on FXCM just because I'm familiar with it. There are, however, other services that you can use. So if you go, for example, to investing.com, and so if you go to investing.com and you open up a live chart, this is the live streaming chart for GBP/USD, and I've opened up the 15-minute chart here, for example. Let's open the daily, and you see it clicks in real time and you can add indicators. So if you wanted to use this, what it allows you to do is you can create an account and then you can sign in and save all your settings, or your indicators and levels, etc. But you can also use it live like this without having to open a trading account, etc. So it does have the benefit of you having to having the experience of trying something out without any commitment. So let's start the conversation then with this while we're on it, and then I'll go back to the FXCM account. So in terms of the indicators, and I'd like to really cover the following. So we'll start with the first one here is the moving averages, and for that there are different things that you can use here. A moving average takes an average of price through a number of periods. So if you're looking at the day chart, it will take a number of days and make an average of that, and then going back for the entire history of that price. So let's try to do that just now, and we go for a simple moving average. So you find it as a simple moving average. Okay, so if you can't find SMA or SN, whatever, so if you can't find it under S, basically, just go for a moving average there. There are different types of moving averages. There's a simple moving average, the exponential, and the weighted. So let's try, for example, the simple moving average there. Okay, and then we'll close that. Here's the simple moving average. Now it gives you a period here of nine periods. You can change that, and you can format it. So instead of 9, you can have it for, if you want a 100 days moving average, for example, 50 days, let's say 100, and that gives you a different view. Okay, so this is the 100. It's kept the 9, so we can just close that. Okay, so this is the 100-day, and you can see that the pound US dollar in the last few days has had a quick shot up, and it's gone up above the 100-day moving average. So there are other types of moving averages. So let's try, for example, to keep that one in just to see the difference. If we have the exponential moving average, can then close it, change the period again to 100. Okay, and then you can see the difference. Now, this is the moving average, and this is the exponential moving average. So they're slightly different. The slight difference is the way in which they interact with price and how they average out. So the exponential follows a slightly different path, and as you can see here from this turn, is more responsive to price movement. So while the 100-day is still on the downtrend, because this is a long-term downtrend for the pound dollar, so that's still going down. This is the simple. It's still going down. The exponential has made a turn much earlier. Okay, and so you can see different types of moving average. I'm not going to cover them all because I'll keep this short, but that's basically how it goes. And the importance of that is that you can remove it like that. So the importance of this is how to use the averages. Some people use the averages for the simple reason of crossovers. So for example, if you have price crossing a moving average like this, that's a buy signal in this case, and the reverse will be true. So let's find an example of that. So in this case, let's say the moving average is under the price, and then if price breaks below, that would be a sell signal. Now you can see that eventually this actually conforms to that sell move, and it did actually continue down. Sometimes you get false signals, and this is much easier to see on smaller time frames. So if I went to a 15-minute chart, for example, and kept the moving average, now this is now going to be not 100 days of average, but 100 periods. So 15-minute periods times 100. Okay, so that's 1,500 minutes. So you can see that there's a lot more chop up and down, above and below that moving average. So it's much harder to use a simple cross signal structure, because you'd be, of course, your targets will be smaller. But if you're looking for trend, best to use this on a bigger time frame, like a daily, etc. So that's the moving average covered. Another really simple strategy is the crossover between different moving averages. So if I went back to the daily and added, for example, a 50, the smaller the number, the more responsive it is to price. So if I went to a 50-day moving average and added that in, and you'll see that you'll get 9 again. So we'll change that to 50, and we'll make it a different color as well. So we'll make it red, for example. Okay, so the red is now the 50. Okay, so now your strategy is, if the quicker or smaller moving average crosses above or below the slower or longer period moving average, then you buy or sell. Okay, so the 50 is looking like it's about to cross, but hasn't crossed yet. What you notice here is that price is actually crossed through the 50 moving average and the 100 moving average. And so if you went for the strategy where you buy when price crosses one moving average, say the 100 period, you'd already be up about 200 and more pips, 250 pips on your trade. If you waited for the 50-day moving average to cross the 100, you would still be waiting to buy. Equally here, you see that price crossed the 100-day moving average on this day, okay, and then the 50-day moving average crossed the 100 here a few days later, about 2 weeks later, and then you went for sell. Price retraced here, so if you went short here, you'd have been in a drawdown here and then back in the money. If you sold here when the two moving averages crossed, then it would be a similar scenario because price retraced again. So in this case, one of the other strategy would have worked equally well, and you would have held that potentially for a while, depending on your target. So there are different ways to use a moving average, and that's kind of one of them. Another one that I use, and I'll go for the second one. This is the oscillators. I haven't really used these for a while, so I'll just go back to that and see if I can show you how that works. So I'll add that in with indicators and go to RSI. And this is one of the oscillators that really does help traders sometimes. And we'll use that for a moment, where price seems to be at an extreme. So if we went for, let's say that we were at the bottom of this long-term downtrend on the pound dollar, and we're trying to decide, price is very low at the moment, and we're trying to decide, we're at 140 here, which is a historic low. We're trying to decide whether to go long. Basically, we're trying to pick a bottom, which is it's very tricky to do, and not many people do it well. Sometimes you get caught out and price continues down, even if everybody says it could not go any lower, but it does sometimes. So, but let's say for that exact reason, you're trying to use an indicator to give you some guidance. And we're looking at the RSI down here, and you see this line. So you've got two levels basically. And the 70 is overbought. I'll make this a bit bigger so you can see. And the 30 here is oversold. You're looking for two things really. When the RSI, relative strength index, crosses below the 30, that means that price is oversold and it's a good opportunity to buy. So you continue watching this, and when it turns, as you can see, price is following RSI, or rather RSI is following price. So it is based on the price itself. So we're trying to decide what to do at this point, and you can see that so far price and the RSI have followed each other, and this is where you see price coming up, and you think, okay, we're oversold, so you buy, but then price dips below again and goes to below 140. But you see that the RSI is not actually coming down to these levels, 15. It's staying around 30. This is where we have a slight divergence, although divergence really is when the RSI is going in the opposite direction, and we're looking for that. And so see what happens after price picks up and the RSI picks up, and then price picks up, and that's where we are today. So had you bought around here, oversold, then you would have been in the money eventually, but it would have gone against you first, and then. So it's really tricky to get it absolutely right, but it does help. Sometimes you do get divergence where you can see clearly. I'll just see if I can get a clear example of that. And if I lock that, there we go. So we're looking for where price moves down and RSI moves up. So here's an example where price is moving down fast, and this is going back to 2014, and RSI actually starts to move up. If you did put a little line there, you can see that quite clearly, that we sort of have a, okay, so RSI is moving up overall and price is moving down overall over this period. So at this point, however, you might start seeing a divergence and think, I'm going to buy. So if you bought at 160, it would have been £1,000, okay, down, because that's 150 and it's still dropping until it dropped to 145 and then eventually picked up. So again, divergence is tricky to use because it's not a guaranteed success. So again, it's sometimes, the RSI tells you that something is oversold, but if you've got sort of historic levels, like that 145 is a very low level for the pound, and 140 as well. So that zone is quite low historically. So you can tell if you're seeing this falling, you either join the downtrend or you wait until it gets there and see some sign of congestion and maybe backing off those levels. Oversold is relative to price, so you have to think beyond just what the RSI window tells you. And that's one of the oscillators. There are other oscillators like stochastics and MACD, which is a moving average based stochastic, and so those are the ones that you can use as well. I'll take the RSI off for a moment and go back to our list. Now we come to something called ATR. I'll do this one first and then come back to the Fibonacci. The ATR is a very good measure of sentiment. So let's use the investing.com and see what we can gauge from that. We'll put that in as average to range. Now again, you can determine the number of periods that you use, so you can have a different amount of periods. So let's see if I can get it in there. here we go. It's 14. The default is 14, and it's the same on FXCM, 14 periods. So if we went for the ATR on a daily chart, what it tells you is the average of price range, and it takes the open, close, and I think the high and the low, but it does essentially give you a visual graph of volatility of price on average. So how price is behaving compared to its sort of average through time, and it takes the last 14 periods. And you can change that, so it shows you at the moment, for example, that the pound average true range is dropping, although the pound is actually picking up quite a bit. That's 13 out of the last 18 trading days from this low at 140 have been bullish. So you might say, oh, it's very volatile and the range is increasing, but in fact the range is dropping. It's going up consistently, but the range is dropping. If you look at the peaks here in the last few months, few weeks, you can see that the peaks are actually on these big bear candles. These are where the range increased. And the same here, these 3 red candles and these 3 red candles registered some peaks, and this big green candle as well. So these are smaller movements comparatively, and so that's why we see this dip here. Now obviously if you change that to instead of 14, you made it double that, say 28. Okay, 28. And that is how it looks now. You still see a dip there, okay, and the peaks just about where we had them before. So again, it doesn't change that too much. If you went the other way, okay, and you went for half of 14, which is 7, you see that it's more responsive, so you see more peaks, but again it's dropping at the moment, so it gives you a similar reading on a smaller time scale as well. So we can remove this indicator and get back to the chart there. So what the average true range gives you, however, is going back to the FXCM. It gives you an indication of volatility. So if we're looking again at this oversold where we were before, okay, and we were looking to pick a bottom, if you like, a low level where to go long, you can see that volatility had increased dramatically and then steadied. So at this point you might have thought, okay, maybe this is a good time to buy. So you could have a strategy where when the average true range indicates high levels, it's an extreme, and after that, when you see a drop, it's a signal to go long, for example. So in a similar way that you might use the volatility index, the VIX, which I've put here in an overlay with the pound dollar. So you can see the purple line here. And when it peaks, that's usually a sign of fear or restlessness. And that's where price drops. And when this peak actually starts coming down again, that could be a signal to go long. So there are different ways of using that, as I was saying. So that could be a sign to go long, where the peak starts falling, and indeed you can see that that's what happened, but it's not guaranteed, so it's more of a measure of sentiment than a signal itself. Now let's move on to this, which is what I wanted to show you, just to go on that, and this is quite a useful one if you want clear-cut levels. And some people swear by it, some people say it's not particularly useful, but I say for short term and medium term it does work, but longer term is probably best. So for that reason I'm going to show you. Let's take this from here, which is March, to here, which is going on. Yes, July to April, July 14, April 15. I'm going to use the retracement. Fibonacci was a medieval scholar and devised a series of mathematical connections between numbers and the golden ratio, etc. You might want to research that separately. I'm not an expert, but anyway. So what we do for the retracement is we draw from the peak to the bottom. We draw the line, and we don't have to be absolutely precise about this. You can adjust it once you've designed it. So you can take it and stretch it or adjust it. And you can see the three standard levels. The golden ratio is 0.61, and there's a lower level of 0.38, and 0.5 is just the derived level. It's the halfway point. Now, let's say we didn't know what was going to happen later. So we drew this, and price started kind of coming up. When we look for retracements, we're looking for retracements of a move. In this case, if we wanted to go long, we'd be looking for a retracement of the move up to, say, the 0.38. At that point, price can either bounce back off that, and if it breaks through, that's a sign to go long, for example. So price in this case went straight through it, bounced at 0.50, came back below 0.38, straight through again, bounced off the 50, and then started chopping around 0.38. So we have three interactions. The first one is breaking through. That could have been a buy signal, but then it would have actually been a false signal. And then another buy signal bounced off the 50, chop and consolidation around 38 for quite a number of days. And then bounced off the 50 again, straight below, bounced off the 38. So in this case, you could say, well, if it broke through the 0.38 and it went long, this would have been a bad trade. So it doesn't always work, but the levels certainly mathematically work because there is an interaction with them. So, and if you went further, we're not actually at those levels yet. So it does sometimes work and sometimes it doesn't. And if you did this with another one, let's see if we can try to show you how two layers of Fibonacci can work with each other. So now you're seeing this other move, which is from the July 13 to July 14. This is 1 year. And this is the up move. It's basically the equivalent. It's almost like a triangle. It's almost the same move. And this was when Mark Carney came to be the governor of the Bank of England, July 2013. And he announced that there would be an interest rate rise in the bank, from the Bank of England. So speculation about that moved the pound up to 172. And then when that became a thing of the past, when the realization came in that was going to happen, you see the result of that. But this move, essentially, the Fibonacci levels should more or less match these, and they almost do, except this move is slightly lower. But if you drew the levels, say, to here, okay, there's a sort of consolidation period here, which is about the same level as that. You see that the two levels, the up move and the down move, match very closely. So you might, in that case, say, okay, if I just went by this move here and use these levels and then wanted to sell, and you see the retracement when it gets to here, it gapped down at this point, and that was around the time of the Scottish referendum. So it gapped down, and then it was a no vote, so the pound should have rallied, and it did, but not much, and it continued down. So the trend was so strong that even the what should have been a positive vote for the pound from the Scottish referendum didn't stop this, and it continued down. Now it broke through the 38, it retraced its up move down to 50%, and then a 61. So by this point, you could have had as a strategy, again, as I said before, in reverse, that if it broke the 31, in this case, the strategy would have been more successful, because if you entered around here, this would have continued. So again, it can work for you, or depending on what you decide to do. And finally, I have this, which is other. And this really is to do with indicators that are not necessarily based on data, but ones that you can get from your broker. So this one is one that gives you news on the chart. So instead of you consulting a news calendar for the economic calendar of a particular pair, you can get it actually overlaid. So what it does in this case, it gives you countdown to upcoming events. And so for today, for New Zealand, Kiwi dollar, and US dollar, these are the events. And I've selected just the high priority, so you can also have different layers. So you can have low, medium, and high. So I've selected just the high impact, what are considered high impact or high risk news events. And going back a month, so just going back 1 month. You can have it going back a whole year, it takes a lot longer to load up, but if you go back a month, that gives you an idea. And what you can see here is reaction of price to particular news events, and that can change as well. So sometimes you can have, this is the previous dairy auction result, and price sort of responded negatively, and then 2 weeks later there was another auction, and this time was positive, so price responded positively up, but then it still went down the following day, so, and with no news. So again, this can be tricky to interpret. News can be tricky to interpret, but this is a good way to check how price responds to news and try to determine which news at the moment seem to be considered positive or not. So for example, if you looked at this day here, you can see from the opposite side, which is the US dollar side of this currency pair, that the ISM non-manufacturing services data from the US came out above forecast, and that means that it was a Kiwi negative response. So this is another useful indicator, although it's an app rather than an indicator, and this is on FXCM. But whatever indicators you use, you must decide for yourself what kind of strategy you want to use, because if you want to base your strategy on technicals alone, then you go for things that are giving you exact answers like Fibonacci and moving averages. Oscillators and ATR more sentiment based, although some people can use that as clear signals. And then again, if you're looking for fundamentals and news derived moves, then maybe the news app can be more useful. So I hope this has been useful for you, and please leave comments, and I'll see you in the next FreeFX video.